Hello, everybody. Scott Riley, the Market Update Desk, hosted by Scott Riley and powered by Mortgage One. Well, February 13th came today, and we were anxiously awaiting the inflation numbers from CPI, Consumer Price Index, and we were expecting some really good information, some good numbers. Well, I feel like I just got out of a round of boxing with Mike Tyson and took a gut punch. Thank you, Bureau of Labor and Statistics, for making fantastic seasonal adjustments again, just like they did on the jobs report a couple of weeks ago. So we got the CPI results, and this is where it came in. So headline CPI came in at month over month up 0.3%. The street expected 0.2, and we thought we could actually get 0.1. Year over year, we went from 3.1% up to 3.4%, so we increased. Core CPI, now remember that strips out volatile food and energy, came in at up 0.4. The market was expecting 0.3. It made it unchanged at 3.9%. We thought we could get all the way down to 3.7%. So there's some things that came in and affected this report that are kind of out of left field and surprising. So the big one, shelter, which makes up a little over 45% of the total CPI, rose 0.6%, took us from 6.2% to 6%. We were actually thought we were replacing a larger number last year with what would be a smaller number this year. The 0.6 really threw this whole report out of whack. We were expecting shelter to be in 0.3, 0.4%. So it does hurt us quite a bit. Rent increased by 0.4%. Year over year, we're now at 6.1%. That did fall from 6.5%. The one that hurt us significantly was owner's equivalent rent. That measures or tries to measure the cost of homeowners if they were then if they would have to then go out and rent something equivalent to their current home. That went up 0.6% and came down, though, from 6.3% to 6.2%. We were expecting that to be much, much lower. And it is a very volatile figure. So where they pull the specific statistic out of is the thing of question for this report. Lodging away from home, 1.8%. That was more than expected. Now, motor vehicle insurance, once again, all my insurance buddies, they love me talking about this, went up another 1.4%. Year over year, we're up over 20% for motor vehicle insurance. No matter what the Fed does, raising or lowering Fed funds rate is going to have a zero-sum effect on insurance because they can't affect natural disasters, thefts, accidents, things like that. So this is something that just can't be affected by the Fed. Medical care services takes up a little over 8% of CPI. That rose 0.7%. Used car prices, we had a little bit of a bonus here. That fell 3.4%. That was a nice surprise. Energy, I'm actually a little surprised on this, fell 0.9%. So that actually helped us during this cycle. Overall, CPI was nothing of what we expected it to be, and we're taking the hits in the 10-year bond and the mortgage-backed securities. Mortgage-backed securities are down over 32, 34 basis points right now, and that's actually not the worst of the day, surprisingly. 10-year bond spiked at one point to 4.29. We're sitting at about 4.27. This report is not friendly to the bond market and mortgage rates. Another report came out today. NIFB, National Federation of Independent Businesses, gave their Business Optimism Index. And it's not the rosy picture that we've been seeing, for example, in the jobs market. So the NIFB reported that small business optimism fell from an index of 91.9 to 89.99. Which is the lowest reading in a little over 9 months. The biggest problem businesses have reported was the quality of labor that they have been able to hire and inflation. Employment within this index, employment plans to increase employment didn't increase, fell 2 points to 14%, showing that only 14% of employers are planning to create new jobs over the next quarter, the lowest level since 2016. But how is this possible if the BLS jobs report showed a gangbusters jobs report? It just shows the seasonal adjustments and double counting that's in that was bogus, and it's not reality of what's on the street and what businesses and consumers are facing. And we just wish the Fed and other commentators would take off the blinders and go deep into these numbers. Economic outlook. Those who expect retail sales to improve fell 12 points, and expect economy to improve fell by 2 points. So we've got the real stuff going on that's in this, that are talking to the business owners, retailers that are on the streets, and they talk to everybody, and they're feeling the effects every day of inflation, the job market, wage prices, and tight credit situations. So definitely not what we wanted today. We're hoping Friday's wholesale inflation numbers will be more of what we expected and help us out. We'll keep up on everything, get the information out to you. We hope this helps everybody understand what's going on every day. Give us a call, 616-293-2189.